Okay, we're going to go ahead and get started. And first of all, thank you everybody for joining our webinar, for registering and joining in on our webinar. The Lunch and Learn series that we do every Wednesday at 12 o'clock has been wildly successful. We're giving a lot of people really great information for either their personal use or for their use as a realtor. And there's some really great topics that we're going to be discussing in the upcoming weeks. I really urge you to take a look at our calendar and what is going to be discussed in the next few weeks, and please register. Now, keep in mind, if you register and you're not able to attend, we will send you the video just because you've registered so that you will be able to watch the video later on. So if you can't attend live in person, we encourage you to please register so that you can get a copy of the video. Next week, we're going to be talking about foreign national loans. This week, we are talking about investor cash flow loans and what are they and what do they mean? Or how can they be used, I should say. So let's just take a step back and discuss exactly what an investor cash flow loan is. It's also commonly known as a DSCR loan, which stands for debt service coverage ratio. So you'll hear those names being used interchangeably. Either it could be called an investor cash flow loan or a debt service coverage ratio loan, or a DSCR loan. But basically what that means is these are loans that are not using the traditional income route to help an investor to be able to purchase a property. It's really an alternative to either a private money loan or perhaps just a no-doc loan. This is really what this is. It's a no income verification loan, but it doesn't mean that they don't have to have documents. It just means they have to have different type of documents. So let's just talk about this a little bit today. First of all, an investor cash flow loan is going to be based on how much of the rent will cover the mortgage payment. So that's where you get the debt service coverage ratio. So what percentage of the rental income covers the mortgage payment? Is it 1-for-1? Does it not cover it 100%? Is it possible that it covers it more than 1%? So these ratios are very important, and we're going to discuss why here in a little bit. But basically, an investor cash flow loan is looking at the cash flow or the potential cash flow from the property that is being purchased. Now, the property does not have to have a tenant in it, and you do not have to have a lease in order for us to count the potential rental income. What they're looking at is an appraisal that is going to tell them what is the potential income. It's called a fair market rental analysis. And what happens is that an appraiser goes out there, and depending upon what we ask the appraiser to do, we may ask the appraiser to do a fair market rental analysis with short-term income, or we may ask them to do a fair market rental analysis with long-term income. It just depends on the property and whether or not we can justify short-term rental income. Now, we'll talk about that here in a second, but basically the concept is the appraiser is going to give us what they feel is the potential rental income, and that's going to come to us in a monthly figure. And then we're going to look at that figure and compare it to what the mortgage payment would be. Just to keep numbers really simple, pardon me, to keep numbers very simple, I'm going to use a $2,000 mortgage payment as an example. So if somebody has a $2,000 mortgage payment and the potential rental income comes in at $2,000, that is a 1-to-1 coverage. Obviously, it's covering it 100%. If somebody has a $2,000 mortgage payment and the rental income comes in at $2,500, now we are covering the mortgage payment 1.25%. Okay. But if somebody has a $2,000 mortgage payment and the rental income comes in at $1,500, now we're actually not covering the mortgage entirely. We're covering it only 0.75%. In other words, the rental income is equal to 75% of the mortgage payment. So these ratios are really important because they determine many things. And it's very important that you're working with a loan officer who has really extensive experience with this type of loan. And I'll tell you why. When you have a client, so if you're a realtor listening in, or if you're an investor listening in, when you have a client who is about to make an offer on a property using this program, it's really critical that they understand the impact that the potential rental income has on the loan itself. And what I mean by that is depending upon what the coverage of the ratio comes in at. So whether it's 100% coverage or doesn't cover it 100% or more than covers it 100%, that's going to dictate not only the rate, but the down payment. So you may have somebody who's anticipating putting down 20%, and then the debt service coverage ratio comes in significantly lower, and now they may need to put down 25 or 30%. Or you may have somebody who is putting down 20% and they're looking for a better rate, and the fair market rental analysis comes in even better or much more coverage, and they may be eligible for a better interest rate at that point. So there's all kinds of factors that come into play. And it's very important that the client is prepared really appropriately from the beginning to understand that. A lot of loan officers are not explaining this correctly. They're saying, hey, it's a no income verification loan, and you don't have to worry about providing your taxes and your pay stubs or any of that stuff. That's all true, but you have to be prepared to understand what the potential rental income will be, and at least have a rough idea. It's always a great idea if you have a client who's utilizing this product to have a discussion with your loan officer, which will hopefully be somebody from the Truth About Lending, to say, hey, my experience is the potential rental income on that area is maybe $1,500 a month or $5,000 a month or $3,000 a month. These are discussions that you need to actively have with your loan officer, because it's super important that we understand what to expect. Now, we're going to also look at the possibility of using short-term rental income. Now, short-term rental income is possible to use with an investor cash flow loan or a debt service coverage ratio loan or DSCR loan, depending on the property. And I'll tell you why. It is much more likely that a bank is going to believe that there will be consistent short-term rental income on a 2-bedroom townhouse that's near the beach, or a 3-bedroom condo that's closer to the beach, or even if it's not necessarily right near the beach, but it's somewhere in Florida that's a smaller property, okay? Like a 2 or 3-bedroom type of property that tends to have a higher rental income for short-term rental incomes. So if it's a house, let's say it's a 5-bedroom house, is out somewhere in more of a let's say out west or something like that, could be somewhere in the Parkland area or further west into Broward. And this is, of course, not just for Broward County or the Tri-County area, it's for the entire state of Florida. But if it's in more of a residential area that's a bigger house, that it's less likely to be rented on a short-term basis. And lenders see that, and so they're more apt to using long-term rental income. And the reason why that's important is most of us know that with short-term rental income, you're actually going to get a higher yield or a higher amount of income from an appraiser, as opposed to the long-term rental income. And the higher the income, the lower the or the better the ratios are, the lower the rate, the better the options are for the client. So the higher the income, the better. And so if we have an opportunity to use short-term rental income, that is something that's really very helpful. There is also a program called Air DNA for those who have not signed up for that or are not familiar with that. That gives us projected vacancy rates. It gives us projected rental income on an annual and short-term basis, and allows us to be able to really determine what we should expect. Now, let's just talk about the fair market rental income analysis and the rental income. There is actually a 25% haircut that is taken by the lenders for vacancies. So in the analysis that I talked about earlier, it's not exactly that easy, because if somebody has a $2,000 rental income from an appraisal, remember it's from an appraisal, then we have to take 25% of that off. And it's basically because of vacancy factors. So a $2,000 rental income analysis from an appraiser would actually only give us rental income of $1,500 because we have to take 25% off. So these are all things that we're thinking about as loan officers when we're giving somebody a pre-approval letter. We are telling them, listen, you may need to be prepared to put down some additional money if the rental income analysis does not come in at something that is good. Now, let's say there's a tenant in the property and you have a lease. Even with a tenant and a lease, you still have to get a rental income analysis. And in that situation, the bank is going to use the lower of the two. They're not going to use the lease income. There's different requirements for when somebody is refinancing a property, and that's not something we're going to talk about right now. This is a loan that is eligible for refinances. So if you have an investor who owns property free and clear and they want to pull some cash out, but they don't want to do a private mortgage or get really stuck with the super high rate, this is a program that they could potentially use to diversify their portfolio and purchase more properties. So let's back up for a second and talk about what's the difference between a conventional Fannie Mae investor purchase and a investor cash flow loan. So this is really important to understand, because besides the obvious of the fact that with a Fannie Mae conventional loan, we need to document income, and we're going to be looking at their tax returns, and we're going to be looking at all of the normal standard income part of it. There are some other differences. For example, with a investor cash flow loan or a DSCR loan, a borrower could actually purchase the property in an LLC or a corporation and personally guarantee the loan. And because they're doing that, they're able to limit their liability. There's many investors that really would like to keep a property in the name of a corporation or an LLC. So for Fannie Mae or for conventional loans, that's not allowed. That's a biggie. Some people really, it's very important for that. Now, here's also another big thing. You're not allowed to have a gift on a conventional loan. So when it comes to investment properties, I should say. So on an investment property purchase with a Fannie Mae conventional loan, you cannot have a gift. It has to be their own money, or it has to be like secured borrowed funds, like maybe they're accessing an equity line or something like that, but it has to be their own money. With the DSCR or the investor cash flow loans, it doesn't have to be. A gift is allowed, and that's okay. So you may have somebody who is purchasing an investment property, they're doing it through a conventional route, and their loan was denied at the last minute because they have a business partner that gave them money towards the purchase, and that business partner is not on the loan, and now that's being considered a gift, and now that loan is about to die. So now then we can switch it to a DSCR loan or investor cash flow loan, and now we are able to save the loan. So that's an example of one of the critical things when it comes to the differences, the two main differences that we see. There's also some other differences, but for the most part, the most critical differences are gift funds and being able to purchase a property in a corporate name. Now, I do want to clarify one thing. When doing a conventional loan, we can use the potential rental income if the investor has experience. So that is allowed. But when we're talking about the DSCR or investor cash flow loans, there are a lot more flexibility on the guidelines. So let's just go back and talk a little bit about these ratios and what they dictate. So for the most part, when somebody has a one-to-one coverage, when the mortgage payment is covered 100% by the potential rental income, which, like we just discussed, is determined by this fair market rental income analysis from an appraiser. And then we're taking only 75% of that. So when the mortgage payment is covered by that, and it's a one-to-one coverage, if it's a single family home, probably can put down 20% depending on the credit score. If it is not covered one-to-one, if it's less than one-to-one, you're probably looking at putting down 25%. And if it's below 75%, so the mortgage payment is more in that situation. So the rental income is less than the potential mortgage payment by more than 25%. So if it's only covering the mortgage 0.75%, then the borrower may have to put down as much as 35%. So you can see there's some pretty big differences here. So this is really something that we've got to have a client fully prepared for, or try to do as much due diligence as we possibly can on what the potential rental income will be from the beginning. It's very important that we're looking at all of these factors. On top of that, in addition to the down payment, which, by the way, that down payment changes depending on the property type. So if it's a 2 to 4 unit property, a fourplex or a triplex, you may already be starting at 25 or 30% down and going down from there, depending upon how much the rental income would be. And if it's a condo, the same thing, depending upon the condo, you may be starting at 30% down as an investment property. So everything is really dependent upon property type and the potential rental income, so we can look at what the ratios are going to be. So circling back to what I was talking about, in addition to the down payment, one of the requirements is to show reserves. What exactly do we mean by reserves? Basically, we want to show that the client is not going to be completely broke after they purchase this property. So whatever the mortgage payment with taxes and insurance, the prorated portions of those taxes and insurance. So for example, the mortgage payment with taxes, insurance, and everything association dues, let's just say it's $3,000 a month. We need to show 6 months reserves. So we need to have $18,000 in reserves somewhere in the bank to show. Again, with this program, remember, they can receive a gift. They can also, for the reserves, use retirement accounts. They're not taking the money out of the retirement account. They're not doing anything with the money. They are simply just showing that they have the reserves. And this is pretty important because with a conventional loan, there's also reserves. But with a investor cash flow loan, remember, we have the ability to use gift funds if for some reason they're short on reserves. So these are all things that a good loan officer will really prepare a client for, not only in a worst case scenario of what happens if the rental income doesn't come in, but what also are we looking at for the reserves. So now let's just talk about a really worst case scenario, which often happens more than not, especially in South Florida, because insurance rates are so high. If you get into a situation where there's just very little coverage of the mortgage payment, for example, somebody's purchasing a property and they see the potential for short-term rental income, but maybe the lender does not see the potential for short-term rental income, and the mortgage payment is, let's say $3,000, and the fair rental income is $1,000, or something that's really upside down. It's below 75% coverage. It's just very, very low. We do have options, whereas many other brokerage companies don't have options to go to very low ratios. We do, and it's actually called a no ratio loan. In that case, the interest rates are higher, and on top of that, they may have to put down 35%. But there are options to do no ratio loans where we're not even ordering. Like, we know from the beginning there's going to be an issue, and so we're not ordering a fair market rental analysis to determine what the ratios are going to be, we already know there's going to be a problem with the ratios. And in that situation, we're going straight to a no ratio loan, or we're preparing the client for an option of that requirement. And the reason why this is really important to understand from the beginning is there are a lot of lenders. I mean, we're licensed with like 30 plus lenders, and there's probably only 3 of those lenders that will do a no ratio loan. That means that if you have a client that is using this program, or if you yourself are using this program, there's probably fairly good odds that that lender will not go below a ratio of 0.75. Meaning that what will happen if they can't do it? Your deal is going to be dead in the water, or you're going to have to start over again at another lender. And this is why it's super important to be working with somebody who has really extensive experience with the situation, so that we can try to prepare for a worst case scenario in the beginning, and making sure that we're not looking at this through you know, what did they say, rosy glasses, to be telling the borrower something that is sounding really wonderful, and not preparing them for more of a worst case scenario. So let's talk a little bit about prepayment penalties. So all of these loans have some kind of prepayment penalty. They're typically anywhere from 3 years to 5 years. The most common is a 3-year prepayment penalty. Those prepayment penalties can be bought out or can be bought down. Typically in this situation, we're suggesting to clients to buy the prepayment penalty down to only a 1-year prepayment penalty, because we do feel that the interest rates are going to go down. And as a result of rates going down, these programs will go down also as well. And so we are suggesting that it's better for them to just be in a 1-year prepayment penalty as opposed to a 3-year. The higher the prepayment penalty, the lower the interest rate, or the lower the closing cost. The lower the prepayment penalty, either the higher the cost or the higher the interest rate, one of the two. So these are things that we also have to have a very upfront discussion with the client. Oftentimes, we will have a discussion that says, let's wait for the rental income analysis to come back so we can determine what we feel will be the potential rental income first, and then we can kind of go from there, so that we're basically looking at real figures from the perspective of the rate and the down payment and all of that. So let's just talk about the interest rates. So if somebody's putting down a huge down payment and has a 780 plus credit score, and they're putting down 35% or more, and the rental income is 1 for 1, everything is, you know, either covering it 100% or more than that, and it's really a great deal, we are probably looking at rates somewhere in the low 8s, possibly even the high 7s, with them paying a point or a point and a half, depending on the prepayment penalty. I mean, that's going to be the best of the best case scenarios. And more than likely, it's also going to be very property dependent. So it could be in the low 8s, but that's kind of the best case scenario. On the other end of the spectrum, if somebody has the coverage is horrible, it's below 0.75, there's really, the potential rental income is not even making a dent in the mortgage payment. Maybe we have to do a no ratio loan where we're not even looking at the ratios. It could be as high as the high 10s. It's possible it could be even in the low 11s if the credit score is very bad. For example, we're doing a loan right now for somebody with a 620 credit score who is using this program, and I think the rate's like 11.6. Now, most of the time, people who are doing this program are probably looking at a rate somewhere in the high 8s to mid 9s, depending on the debt service ratio coverage, depending on the credit score, 720 credit score or higher, but the program does go down to a 620 credit score. So we do have options. It's just that the interest rate is going to be worse when it's the lower credit score. But on average, you're probably looking at somewhere high 8s to high 9s, depending upon the property. Now, I know that sounds high compared to where we've been, but when you're looking at the normal Fannie Mae rates that are right now in the high sevens, mid to high sevens, it's not, too much off from where we are looking with the conventional rates. It's a few percent above, which is what the standard is. So when the rates go down next year, which everybody has a very strong belief the rates are going down maybe to as much as 2% by this time next year, that means these programs will be down, hopefully somewhere back into the high sixes to mid sevens, possibly lower. We'll have to see. But these are still 30-year fixed mortgages. There's no balloon on these mortgages. And it's still a much better situation than somebody who is looking at doing a hard equity loan or private money loan. There's also generally, we only charge usually 1 point on these loans, unless somebody wants to buy out or buy down the prepayment penalty, and those fees go to the other lender, or go to the lender, not the other lender, go to the lender. And the costs are just tremendously lower than if somebody was doing a private mortgage. So let's just talk about corporate buyers and personal guarantees. If somebody wants to purchase a property in a corporation or an LLC, and they're only 50% owner of the company, both people are going to have to sign on the documents at closing, but we are allowed to have only one be the personal guarantor. It's just important to understand that there's going to have to be corporate resolutions, and there's other things that are needed from the other person that is part owner in the company, but we are allowed to only use one person as personal guarantor. So let's also talk a little bit about what we're looking at when it comes to the condition of the property. These, there are investment loans out there for people who are doing fix and flip loans, or people who are wanting to purchase a property that needs rehab. This type of loan can be used in conjunction with that. We do have some fix and flip programs that are a no income verification option. Those type of programs are typically a shorter type of loan with a balloon, because of the fact that people are typically not keeping, it's a fix and flip loan. They're looking to flip the property. Now, if somebody is looking to fix the property, keep it on a longer term basis, we can also offer that program as well. It's a little bit different of a program, but we do have construction programs for investors with no income verification, and it's kind of a hybrid of what we've been discussing in reference to the potential rental income. So that's pretty much the story on investor cash flow loans or debt service coverage ratio loans, and what is available out there. Does anybody have any questions regarding these type of loans that we just went over? Let's see. Okay, we have a question from somebody is, can somebody do this type of loan if they're less than 3 years out of bankruptcy? Yes, you actually can do this kind of loan. Let's see. We do have another question. What's the minimum credit score? Most lenders are looking for a 600 minimum credit score, but that's got to be like a huge amount of down payment or equity in the property. And primarily where you're going to get the best rates with the lowest down payments is going to be over a 680 credit score. Oh, one last thing I also want to mention that's super important. We've got to be able to prove where the person is currently living. The lenders want to make sure that people are not using this loan to buy a primary and they're calling it an investment property. It's super important that either they own a primary right now, or they have a property they're living in that we can document the proof that they're living in it. Meaning that they have a lease with canceled checks, that they can provide as proof that they're living in the property, a utility bill, if they don't own the property, something where we're able to document that they are currently living in a property right now that were able to document their either their mortgage payment history through the credit or the rental history through cancel checks or whatever the case may be. And there isn't any seasoning requirement on these programs. So if somebody just put a big chunk of change in their account, that's okay. The only problem would be is if they deposited cash that we can't document. We still have to document the source of where that cash came from. But if somebody deposits a check, that's okay. It's not a problem. It doesn't have to be in their account for 60 or 90 days. Whereas with a conventional loan, it would need to be in their account for a certain period of time. Okay. We have another question. How many properties can somebody purchase with this kind of loan? Really, there's no limit. With this, you know, there are restrictions with Fannie Mae. When you own more than 10 properties, it becomes a different type of loan. But with the DSCR, the investor cash flow loans, you can own multiple properties. So that's not an issue at all. Okay, last question. What is the time frame that people have to be able to close on a property? These loans are pretty quick. I mean, they're not documenting a ton of stuff. So it's usually maybe about 3 weeks from start to finish to close one of these loans. And usually a 20-day financing contingency can be achieved as long as the borrower is willing to move quickly. Or if there are tenants in the property, you might want to ask for 30 days just so that we can make sure we can get the appraiser in there and do the appraisal without any delays. So I think that is it. If anybody else has any last questions before we end for today, please let us know. Nope. Okay, everybody. So if anybody has a client that you'd like to have us speak to regarding this program, please feel free to reach out to us. You can certainly call the 800 number, which is on the screen, or you can reach me directly. My contact information is on my website also as well. And in addition to that, please sign up for next week's webinar, which is going to be a lot of information about foreign national loans. And thank you so much for joining us. If you registered for any of the past sessions, you should have received a copy of the past sessions YouTube video. You can always follow us on YouTube, please, and look at our past lunch and learns as well. Thank you so much. Have a great day, everyone. Thank you for attending.